Hello and welcome to this edition of Business Africa. I'm Amelnga. Coming up, 11 countries supported by AU push for liberalization in air transport, a look at the single markets of African aviation, foreign investment prospects in Africa still hampered by the underdeveloped financial markets and unclear legal regulations, plus Sudan bans importation of 19 products to preserve its currency, the Sudanese pound. First off, Open Skies for Africa is here. As early as 2018, the Yamoussoukro agreement that commits 44 African countries to deregulate air services and promote transnational competition could become effective. Jean-David Muhalme and Ignacia Zano have more.
2018 could mark the beginning of the advent of the liberalization of the African aviation sector with a single African air transport market. This means any African airline could choose to operate in any signatory country and operate domestic flights. 11 countries have already joined this initiative supported by the African Union, which has made it one of the flagship projects of its 2063 agenda. These include Egypt, South Africa, Ethiopia, Nigeria, Rwanda, Congo, Zimbabwe, among others. A liberalized aviation industry in Africa will be a real catalyst for development with a significant impact on trade, tourism and integration. This would also significantly reduce air ticket prices and strengthen the airline industry in Africa. But there are some bottlenecks. The less fortunate countries are still reluctant to adopt the single air market, probably for fear of extinction due to intense competition. However, as Paul Kagame, the Rwandan head of state, pointed out last February, at the last aviation summit in Africa in Kigali, Rwanda, only a single air market is able to favor real economic integration of the continent.
Despite diversity and dynamism of its market, foreign and local investment prospects face several obstacles on the African continent. The Africa Financial Markets Index shows that the transformation of financial markets is key to Africa's next stage of development. Serge Patrick Manku and Ignacia Zano report.
The index, produced by the Official Monetary and Financial Institution Forum and sponsored by Barclays Africa Group, focuses on 6 fundamental pillars including access to foreign exchange and capacity of local investors. The report says, although Africa's large and dynamic markets present opportunities for growth on the continent, foreign investment prospects are hampered by underdeveloped financial markets and a lack of legal and regulatory clarity. It adds that liquidity, regulation, foreign exchange restrictions and policy choices are the highest area of concern for investors when considering Africa. Whereas product diversity and the speed of transactions are among the highest performing indicators, the report highlights investor concern about the relevance of African markets on the global financial scene. It also noted development in financial market debt is important for commodity exporters as they seek to diversify the economies to new sectors. Countries covered by the index have an average debt-to-GDP ratio of 50%, led by high debt levels in the Seychelles and Mauritius at 203% and 127% of GDP respectively. Nigeria, Egypt and Botswana all have ratios below 20%.
To shed more light on the index, we have on phone George Asante, Managing Director of Barclays Group Africa in Johannesburg, South Africa. Hello, George, and thank you for joining us.
And thanks for your audience as well.
With an obvious positive outlook for the continent, despite a few challenges, can the chances of additional investments on the continent be improved?
If that is the benchmark, then you see that from a South Africa perspective, South Africa is able to mobilize a lot more finances to drive its own growth at a much better rate than all the other African countries. And one of the insights that was revealed is the amount of debt and equities issued and trading on South African exchanges to South African GDP. If you take all debt and equities in South Africa relative to GDP is about 60%. I mean, the cluster of all other African countries come to about 5%. So that immediately tells you that there is a massive funding opportunity or gap, which is reflective of where the market development is. So what the index basically is telling us is that if you are able to fix your market to be more open, to be more transparent, deep and broad, you will be able to mobilize much more than the continent has been able to mobilize so far. So that is really the opportunity, riding into our conversations with investors and what investors are saying. Investors let us understand that there is appetite for the continent. They see the opportunity. But until the continent gets to a point where the continent becomes open and accessible from a financial market development perspective, it becomes very difficult for investors to lock in their funds into the continent.
Kenya and Ghana, some of the largest economies in Africa, are showing signs of progress despite the political challenges they faced after heated elections. But what lessons can the rest of the continent draw from these two examples?
I think you cite two very interesting markets. And the first point to make about Kenya and Ghana is that these are two markets that have recognized the importance of their financial markets and what the financial markets can do for every country from a funding mobilization perspective, away from the traditional funding which normally comes from traditional banking practices, loans being given to people to fund their market. To talk about specifics in Kenya, the thing they've highlighted is the importance of developing the financial market. So there are concrete steps that the government has taken in terms of prioritizing development of financial markets. If you move away to West Africa and you talk about Ghana, we're quite proactive and innovative in some of the products we put in the market. Just recently, they issued a 15-year bond, which was the first in the market. And then there's a lot of sponsorship from government for capital market development similar to Kenya. Ghana still needs to work on issues that have to do with their stock market. The stock market is almost illiquid.
Would you recommend a more flexible regulatory regime on the continent to promote transparency in the treatment of foreign capital inflows?
That is a very important question. And through the index actually talks about the capacity of local investors, and it also talks about the importance of allowing the easy access of investment opportunity by foreigners. If you look at the index and the report that's been generated, you will realize that out of the 17 countries that were surveyed, only 2 of them have flexible exchange regimes. Now, what that does is that it impedes the ability of investors to determine the true value of their assets being held in markets at any particular time. And that then blocks the amount of potential money that can come into the market to drive activity. The legal regime is not really about flexibility. It is about giving assurance to participants in the market that you know the outcome or the potential outcome of agreements you enter into in the market. And we found that half of the countries that were surveyed actually didn't have legal regimes that give that assurance. And that then becomes an impediment, because I will never trade with you if I know that the outcome of the contract that I'm entering into with you is not going to be 100% certain on what I am entitled to in the contract.
Thank you, George Asante, for your insights.
Okay, thank you very much, guys. Cheers.
That is the Managing Director of Barclays Group Africa. After the break, we'll head to Sudan, where importation of 19 products is bound to protect the currency. See you shortly.